Welcome to Stock Talk with Nico Kritikos. Today, we're going to be going through 10 stocks I have bought and will be buying in December 2021. So let's start with number one, which is DocuSign. If we look at this one, we can see I made a video on this last week if you want to see my full analysis. But the bottom line is they are number one in e-signatures, and that industry is only going to be growing over the next couple of years. And as you can see, the stock was trading at over $300 just a couple months ago, and it dropped all the way down to 137. Looks like it's falling even more now after hours. But and it's just because their numbers, their growth numbers for billings was a slight decrease. They're still growing. It was up 28% year over year. It was down a couple percent from what people were expecting. So it did not deserve to get sold off 55%, 56%, so that was too much. But anyways, I bought 12 shares at $142 a piece. It looks like it's fallen even more now. So if this goes down to maybe 130 or 120, then I'll probably double my position size on this. So that's number one, DocuSign. Next up, number two, SmileDirectClub. I also made a video on this a couple days ago comparing SmileDirectClub with Align Technology, because they both do the same thing. They both make those alternative to braces where you put the thing in your mouth and it straightens your teeth. The treatment process is a lot shorter for SmileDirectClub, and they also charge a lot less. And Align Technology has been very successful with this in the past decade or whatever. And SmileDirectClub is in the perfect spot to become the second biggest player, but they've done a really bad job over the past couple of years executing, and the stock has gone from $15. It IPO'd 2 years ago at 20. A year ago it was at 15, and now it's at 3, which I started buying at $2.80. So I got 175 shares. This is a very small position for me because I don't, this is a very risky, volatile stock. Although I do think I bought pretty close to the bottom, but I didn't want to make it too big of a position. But this one too is, if this turns out successful at all, if they do come out with some good news or something, this isn't one I'm expecting to get a 30% or 40% gain on and then selling. This is going to be one where I end up probably getting a 3x on my money, a 5x on my money, something like that. So that's why I'm okay with keeping it a smaller position size, but it's definitely one you should look into if you are interested in something like that. But number three, we have Square. Now, I think a lot of people are familiar with Square. This is a very popular stock. Late October, early November, you can see all the payment stocks were getting beaten down. This includes Visa, MasterCard, Square, PayPal. And the reason this is because Amazon and Shopify companies came out and said they're not so sure if they're going to need these third-party platforms in order for payments. And I think Amazon said next year they're going to stop accepting Visa or MasterCard payments from the UK. So it was stuff like that. And it was that's what started it. And then this past month, we've also seen, there's been so much volatility and selling pressure on so many stocks that the Square got pushed down to $170 a share. And this was a stock that was $280 in the summertime. So when I saw this at 176, I thought this was a great deal. So again, I didn't make a huge position. I just, took off. This is probably like a third of what I would build this into. I got 7 shares at $176. I'm already up, a couple percent on it. So we'll see what happens. If it keeps going up, then I'm happy with my gains. If it falls down a lot to maybe 150 or 160, then I'll buy more. So Square is here to stay. They're not going anywhere. They have Cash App. They have so many different sources of revenue. I'm not worried about that one. Next up, number 4 is going to be Palantir Technologies. This is one that went IPO a little over a year ago. Yeah, a little over a year ago. And it comes down right around this $21, $22 mark pretty consistently. And, it bounces up to this 28 mark, and then it comes back down to around 17, 18. So I bought in at 21. It might have been a little bit too early, but I'm okay with that because this is going to be one I can hold for the long term. If you don't know, Palantir is kind of like they're like a data processing company. They have really large contracts. They have a really sticky business model. A lot of their customers end up paying them millions and millions of dollars. So they have a lot of government contracts, but they do data processing and they have artificial intelligence and it's stuff like that. But this is another one. I bought 110 shares at $21 a share. And as you know, it normally bottoms out right around this $18 mark. So we'll see what happens with that one. If it shot up a bunch, if it goes back to this close to this 28, I'll probably sell it just because I know it's going to be a volatile stock. It has a very large valuation on it. It trades very rich, but that's because I think a lot of people know that the future of this company is going to look good. So we'll see what happens there. But that's Palantir. Next up, number 5, we have another payment processing company. That's PayPal. PayPal owns PayPal and Venmo, along with a bunch of other companies. This is just a giant of a company. The highs for this one were about $308 a share. And this was pretty much the same story as Square, where you had the payment stocks getting beaten down along with just the negativity in the market. And this one came down. I started buying this one too early, $213. I started buying it at least I got my cost basis down. And this one was trading as low as, 179 in the past couple of weeks. So, I mean, I'm still happy with this one. This one, I have a pretty big position. I have over a $5,000 position in this, that's a bigger size position for me. So, this one, the reason I built it out that big was because I feel safe with this one. So yeah, I think this will be back to around a $250 stock pretty soon, sometime in 2022. And then, I think PayPal is here to stay. I don't see them going anywhere. So I feel pretty safe with PayPal. Next up, we have Zillow. I think I own ZG. I want to say, yeah, ZG. So Zillow, this one has just been crazy over the past year or two. So where do I start? Okay. Zillow. This is a lot of these stocks are famous for Kathy Wood and ARK Invest. She buys a lot of these. So this is a famous Kathy Wood stock, and it got hyped up like the rest of them in 2020. It went from, $40, $50 a share all the way to over $200 a share. And now it's fallen. It was on a pretty steady decline. And I think I started buying right around here in the $90 mark, and it started going up. And I thought, okay, this is, things are about to get good. But no, they came out and said, we're not doing the iBuying business model anymore because it was too hard to predict the pricing. It's a very capital intensive business. They were getting too much inventory. They were flipping houses for a loss. But I mean, it's definitely scary when something like that happens and you think that the revenue is going to be cut in half next year. But so the stock got beaten down horribly, and I was down pretty big. It came all the way down to $52 a share. Luckily, I was buying along this time, and I got my cost basis down to about $78. If the stock falls lower, I could buy more shares. I would like to lower my cost basis even more. I could be in this one for the long term, though. I think Zillow is going to be another one it's a long-term success story. They are number one in online real estate. So they have, if you go to their website and you read their files, I think they have what, I want to say 200 million people. I think it's over 200 million people going through Zillow's website to find, realtors or find houses. So that's a lot of attention to have on your website. So this one, I can keep this one. I mean, they dropped that, what's it called? The iBuying, the home flipping. That's fine. They dropped that. And now I think they're more efficient. I mean, as long as the management team, the management team says they're going to do a share repurchase program. They started off with, I think, $750 million of buying back shares. They're probably going to keep purchasing more shares, and that's going to help out the stock. It gives more confidence to the investors. So I don't want to say I'm too worried about this one. I think this is going to be another successful one and be back at $90 a share sometime next year. So yeah, this one I'm also very confident on too. Next up, here we go. Another Kathy Wood stock, Teladoc Health. This is one I started buying this one. I've swing traded this a couple times in all this volatility because it had the same kind of a similar run to Zillow, where this was $300 a share, and it came down to, around $130 a share. And I think I started buying around there, and then it started, the past couple months or two, the past month or two has been really bad for the stock. It got down to what, $90 a share. Okay. So my cost basis is 115. I have 27 shares at $115 a share. This was one where, okay, so a lot of the Kathy Wood type of stocks, the growth stocks, those are getting really beaten down this back half of the year. Okay. So you have that going on in the market. And really the only companies that are doing strong, holding up the market right now are like the big ones, the Apple, the Google, the Microsoft, Tesla's doing good, Nvidia, maybe a Qualcomm, and then you have things like Home Depot too that are doing strong. But something like a Teladoc Health, any company that's not profitable right now or had a lot of success during the pandemic, like TDoc did, those are not doing good right now. So Teladoc, another reason there was negativity around this one was because their growth numbers were slowing down just a little bit. Especially, you have to think with all these stocks, the comps on these stocks, when you compare these numbers to the pandemic numbers, of course they're going to virtual healthcare meetings are of course going to be higher in, more popular during the pandemic. So of course those numbers are going to come down. But I mean, this one is another one that if you look out long term, the number one player in what's it called, in telehealth, they're going to be here to stay. That's not a business that's going away. So this is what I feel like my $115 cost basis is good too, because I think this is coming back to this $150 level at some point next year. So TDoc is another one beaten down right now, and I think it's a good opportunity to get into it. Next one. This one is a really big position for me. I started buying this too early too. This is Wynn Resorts. I started buying this somewhere around $100 a share, I want to say. I think it's because I was just getting too greedy. I saw that I thought after the pandemic that it was bouncing around $130 a share. Let's see, where was it? I want to say, so yeah, I think back here it was bouncing around $130, $140 a share earlier this year, and it came down a lot, and that's when I started buying, and then now it's gotten beaten down even more. This is mostly because of China. Okay, Wynn Resorts has properties in Macau. Macau is number one in the world for casinos and gambling, and that's where a lot of money is made for these resort companies. Okay, so of course that's going to help, or that's going to really hurt Wynn Resorts. And they're still making money from their Las Vegas properties. I've been there twice during this year. It's super busy. It's the nicest hotel on the Strip. And they also have a property in Boston. They just announced a couple of days ago they're building like in a giant arena, I think, outside the Boston Encore property. So you have things like that happening. The other thing with China is they're going through a lot of regulation discussions right now. They said they might restrict some gambling and stuff. So that's what's bringing a lot of negative sentiment to this stock. And then you also have COVID fears. You have anything that has to do with the virus out there. That's of course going to hurt these numbers. And I also listened to the Q3 earnings call for Wynn Resorts, and it was fantastic. The management team, they had lots of great things to say. They said they had it was very busy. They had tons of people applying for the jobs, and it was just a lot of positive things coming out of that earnings call. So that's another one that makes me confident. Normally I would not make a position size this big. This is over a $7,000 position. Normally I wouldn't do that, but because I started buying too early, I just had to average down when I saw it at below $80 a share. So this $92 cost basis is not bad. I wish I would have got it a little bit lower, but it is what it is. So that's Wynn Resorts. Very bullish on them. Number 9, we have Carnival Cruise Line. A little bit similar to Wynn Resorts. It's also a travel and leisure stock. They're number one in cruise operations. And this is another business that, they're hurt severely by anything that has to do with COVID. Anytime there's talks or fears of COVID in the market, Carnival gets beaten down really bad. And this is you have to be careful because of this one, because this is not going to come back. When you look at this chart, you think, oh, okay, it was $70 a share right before the pandemic. It was $50 a share. It has to get back to that point eventually. Well, no, because they issued a lot of shares, and they diluted the shareholders a lot. So in other words, the market cap at this point, back in January 2020, is the equivalent to the market cap of $30 a share today. So it's almost been cut in half. So in other words, you're going to see back to normal levels would actually be the stock being $30 a share today. And it's gotten close to that. If we look up here, we can see it hit $30 a share in the summer. And I started buying around $20 a share. It got beaten down really bad just because of new variants and stuff. So this is another one. This one is a little bit over I think it's around a $4,000 position, 195 shares, a little under $20. This is another one I feel safe with. I listened to their earnings call. They had lots of great things to say. They did say that they're planning to get in full operations in springtime of 2022. I think they said Q2 of next year. That's when they expect to be back on track with all the different ships and everything. Another positive thing was a lot of companies did this, was coming out of the pandemic. They learned about which parts of their business were not as efficient and which ones were not as profitable, and just how to run things better. And this is a perfect example of that, because I think going forward now, I think you're going to see a more efficient business model and probably better margin. So that'll be something to look out for, to see is their operating margin and profit margin better than where it was before. But yeah, that's Carnival. So that one I'm also bullish on. And finally, number 10, this is not a big growth stock or anything. This is one I've held for probably a year now. And this is Walgreens. This is, I think it's, second largest pharmacy. Number one is CVS. Number two is Walgreens. Walgreens is, they've been around for so long. Earnings were their numbers, their revenue and income was a little bit lower in like 2019. And then this year, though, 2021, the numbers are looking really good. That's why I think this is easily going to go back up to $55, maybe $60 a share. Dividend, this is mainly just for a dividend play. So I have 115 shares, a little over $5,000 of Walgreens stock, and this is just for the dividends. They pay me what, 50 something dollars every quarter. So this is really just for, a stable source of dividends. And if you're looking for something like that, this is a good one to get into. It was trading at, last year it was trading around $40 a share, I think 35 at one point. But during this year, it's really been just pretty steady around this $47, $48 mark. So if you can get it around 48 or below, I think that's a good price to get in at. And you're going to be getting 4.5% dividends. So yeah, those are my 10 stocks that I am buying in the month of December. Thank you for watching, and let me know down below what stocks you are buying.